Hello everyone, it's Alex, and in today's video we will be talking about cooperation between business and risk guys, how to achieve best results working together. Today's video will be in English, karena bahasa Indonesia saya belum bagus, but I asked my wife to help me with Indonesian subtitles, so please feel free to use them. And today we will be focused more on approval rate part. So if you are from risk department, please feel free to share this video with your colleagues from product and business department. Discuss it. If you find something interesting here, feel free to discuss. And with that, let us start. So let's talk a bit about what business needs and what risk needs. Business and the whole organization needs volume. We must disburse as many loans as possible. In the end, volume of our credit portfolio is generating money for us. How to achieve it? Approval rate definitely would be helpful here. The higher approval rate, the better for business. High limits to satisfy all customers with amount we are offering them as a loan also would be helpful. And to provide best customer service, process also must be fast. Depends which product are you selling, mortgages or pay later payday loans. It can be different, of course. So it depends really on some market benchmark for your product. If it's fast, small loans, 1-2 minutes. If it's mortgages, maybe 1-2 days is also okay. Totally depends on some average time on the market, but the faster the better, of course. And what risk needs? Of course, risk is responsible for keeping risk as low as possible or at least below budget. Also, risk guys want to know as much about customer as possible. It helps to make underwriting strategy stronger. Income would be good to have verified, so we don't just trust customer what he's claiming for, but we know that he really has this income flow. And of course, all possible fraud must be eliminated, otherwise it can have very negative impact to risk. So how to achieve best cooperation here? We must understand that both business, product, risk, all of them must work on a common goals. And those common goals I suggest to define as volume and risk. Because volume is what generating profit for us, risk is what can kill profit. And let's discuss this in more details. Today we will be talking about approval rate. And the most popular question from business, why approval rate is low? I believe everyone who works in this department faces question several times. And what you want to talk about here, that approval rate is not only result of risk strategy of some strange setup of underwriting guys. That's not true. In reality, incoming population which are applying for loans impacting approval rate much more than underwriting strategy itself. And I'm going to explain how. And I suggest to define here 3 main things which are impacting approval rate. It can be 4 or 5, it depends how you group them. Let's talk about it in details on the next slides. But we must understand that channel and product defines incoming population quality. So it defines population which risk guys in the end are working with. And yes, risk guys are mostly responsible for the strategy itself. And this strategy reflects 2 things. Quality of your underwriting. The stronger your underwriting, the higher you can have approval rate with the same risk, and your risk appetite. If you have high risk appetite, you can increase your approval rate. If your risk appetite is extremely low, you must keep approval rate low. So let's talk a bit about each of these points. Let's start with the channel. Here you see several characteristics of a channel. And let's talk in the details how they can impact quality of your incoming population, and in the end, how it can impact your approval rate. Let's start from online, offline granularity. You can run business online, you can run business offline. If you run business offline, it can be either branch, big bank office, or it can be some point of sales in some shop. Point of sales can be in big shop, can be in small shop. All of this impacting quality of population you are working with. The less risky is population, usually in your bank office. People already know what do they want to take, why do they need loan, so they have already some decision in their head. And if you are selling your loans, let's say in some point of sales, people can make some spontaneous decision. Maybe they didn't want to take any loan, but they saw some phone and they decided to take it, to buy it. So population, of course, in this case will be more risky. And online, usually in online, share of fraudsters who are trying to get a loan, share of people who are just applying everywhere to get some positive decision, share of organized fraud is much higher. So if you are running business online, you should think more about your verification, about your anti-fraud measures, about your verifying customer ID, customer documents, etc., etc. So online is the most risky channels, and you must keep it in mind when you are working with online channels. Your bank office, your branch usually is the less risky. All other parts are somewhere in the middle. Please keep it in mind when you do a setup of your risk strategy. Then let's talk about big data costs and waterfall approach. What is it? It's more for risk, guys. If you are running business online, you can get a lot of applications, but those applications could be not finished. They got some preliminary decision from you or final decision, yes or no. But in reality, those people are just trying, just checking how big limits they can get, will they get a loan or not. It can be some credit broker applications which are blasting to all financial institutions they know. So you have so-called high drop rate when customer is approved, but he didn't pick up a loan in the end. And if you spend expensive big data, if you call it already in the strategy on the first stage, it can cost you quite a lot. We can have separate webinar on this for so-called cost benefits analysis. But what I want to touch here, you can use waterfall approach when in the beginning you are using either free big data sources or very cheap big data sources. And on the last stages, when you already have much more probabilities that customer will pick up a loan, you are using final big data, the most expensive big data sources. That's, again, we can uncover separately because topic is quite big. And about region, there are different populations, different type of population, different regions, and some of them can be impacted differently by macroeconomic situation. Just give you a simple example. Bali was heavily impacted by COVID because most of the people working there with the tourists, they are self-employed, and when touristic flow just stopped, they were very heavily impacted and they were really struggling with this economical situation. And the best way how to understand your regional differences is analyze your own data. Check your data and see how customer profile look like in different regions for you. What is the approval rate? What is the risk? On the top of that, you can use also credit bureau data to get some general understanding. But the best way is combine credit bureau data with your own data, because for your own financial institutions, it can work a bit differently than generally for a market. And last point here is a promotion method. Again, depends how do you promote your products. If you are blasting your offers everywhere, it's all over the internet, you must expect all type of populations applying. If you are showing only some marketing flyers to the people who are coming to the bank or only in your website, you are getting more trustworthy population, you are targeting more customized population which are looking for a loan. So here you must think about where to find the people who needs your product and also quality of population. So in the end, by combining those things, you must understand where and how much to spend on your promotion and which type of population you can expect from that. That's, I think, about channel. Let's move to the next part. So let's move to the product. And when we are talking about product, in the first place, we are talking about competition. If you are alone on a market, if nobody provides any loan, in the end, you are competing only with customer choice. He can choose with pay by cash, he can choose not to buy this thing at all, or he can take your loan. So you can be more flexible here. You can dictate conditions already on the market because nobody on the market. But usually in real life, it's not like this. Usually you have competition and it can be quite tough and it's getting tougher and tougher. And that's why you always must keep in mind your competitors' conditions on a process, on a documents, on a price, on a brand awareness. Let's go to brand awareness. If you are a market leader, then it's easiest for you. Usually you are a customer priority. If you are working with dealers, with some sales agents, you are priority number one for them. If you are new for a market, it could be very tough for you. Let's imagine you are trying to enter the market of car loans or bike loans, which is already established, and all dealers, all auto bike centers get used to work with verified partners who is on the market already 10, 20 years. And you appear as a new guy there, you cannot really expect best population. Usually you will be outsider, usually you will get population which are not accepted by other financial institutions. So you must really think about how to build your relationships with dealers, with sales agents, with the shops where you are represented. Be cautious with that. About document requirements. Usually for these guys, the more documents, the better. For sales guys, vice versa. But again, it depends which product are you selling. If you are selling payday loan, when decision is in 1 minute, customer doesn't expect to provide a lot of documents. If you will ask him everything, electricity bill, water bill, some family card, probably he will not apply because he needs immediate decision, quick decision, and competitors can provide it. If you are talking about mortgage loan, customer usually expects to provide documents. So you must find some balance here between simplicity of the process in the product which you are selling, and also you must think about your competitors. What are their requirements here? Price, of course, very important thing. Again, you always need to keep in mind which product are you selling. If you are selling mortgage with a huge amount of money with a long tenors, even 1% interest rate can be very significant, and customer can try to find best solution on the market for them, especially if they are the best customers. They can be really price sensitive because 1%, 2% interest rate make a huge difference on a 15, 20 years when you are borrowing big amount of money for a house. If you are selling payday loan somewhere in the shops for phone, for some furniture, then of course customers are much less sensitive to the price, and you must keep it in mind when you are thinking about your competitors, when you are thinking about your own product. You must measure this customer sensitivity to price on your own market. It can depend on the region, it can depend on the type of channel you are selling, and it totally depends on the type of a product you are selling. But overall assumption is that cheap price can help you to attract better customers. But again, keep in mind product always. For small loans, it's not working so well. And the difference in price to attract best population can be very significant. For mortgage loans, even 1% below market can make a big difference for you. Then one more point is the time to approval. Again, the same examples from me. If you are selling payday loans and instead of 1 minute, which is benchmark for a market, you are doing decision in 1 week, I don't think you will get a lot of population, especially a lot of good population. If you are doing mortgage loan and the standard for a market is 3-4 days, well, not try to make it more than 1 week probably. So always keep in mind product and a benchmark and your competitors. And incentive for sellers also, let's say you have ideal product, ideal time to approval, no any documents, very high brand awareness, but somebody else who is represented in this shop or in this dealer center paying 10 times more for the sales agent for every contract. That's why it's very difficult in this case to compete with them. And you always need to think about how much, or try to learn, try to know how much sales agents or dealers are getting from your competitors, how much incentives they are getting, because it can also impact in the end your incoming population. They can, for example, start suggesting, offering best customers products of your competitors. That's about product. Let's move to the last part. Okay, let's move to the last pillar, my favorite, which is risk strategy. And please notice that risk strategy is after your channel and your product. You already define population, customers are already applying. So these guys are working with a given population. And let's discuss how they can still improve approval rate, even considering the fact that population is already given. First thing is data about customers. The more you know about customers, the better, of course. I think now it's enough company on the market who are providing you all possible big data sources. Some bank scraping, web scraping, credit bureau data, telco data, everything you can imagine. What you must keep in mind always is cost-benefit analysis, which we will be talking about in the next videos, that you must compare how much you pay for this data and how much benefits it brings to you. But overall, standard rule, the more you know, the better, the stronger underwriting, which means you can provide higher approval rate with the same risk. Data quality is from the same area. You must always monitor stability of your big data sources. You must always understand how clean is the data. If this big data source is unstable, if today is working, tomorrow is not working, it will be impacting again your underwriting strategy, your stability of underwriting strategy and quality of your underwriting strategy. Then about strategy audit. Usually risk strategies are pretty complicated, and it's not good when only 2-3 people in all organization knows how setup looks like. So sometimes risk guys themselves must do some audit, must go step by step from the beginning till the end of the strategy and audit themselves to find some possible mistakes, some possible gaps, some things to optimize. They always exist. It can be big or small, but they always exist. There are always something we can do better. So these guys can do it internally, or we can find somebody externally. We can find somebody to verify, to check how good is the strategy. Your risk appetite. Everyone is doing forecast. Everyone is doing yearly forecast, maybe monthly, weekly, and usually risk appetite is defined by company strategy. In tough times, you can have low risk appetite. In a good times, you can allow a bit higher risk appetite. So in the end, the higher risk appetite, the higher will be your approval rate. No any surprise here. And the last point here, which I want to make a separate video because the topic is pretty complicated and it's mostly for risk guys, is a balance between risk and approval rate. And what I want to touch here is 2 points. On a high level, first one, you must provide positive marginal profitability with your approval rate, which means every customer you are approving on its lifetime in 2-3 years, depends on your definitions, must bring us positive value, must generate for us profit. How to evaluate it, I will be talking about in a different video. And second very important point, which probably I could touch earlier when we were talking about competitors, your approval rate must be competitive. So if somebody else is providing the same type of loans as you and their approval rate will be higher, it will be much higher, it will be difficult to compete on the market because all sales agents, all dealers will be offering them in the first place just because they know that they can have higher chance to be approved, which means this customer will be more satisfied and themselves will spend less time on every customer. So what's the point to have this application to spend time with customers? He will be in the 90% of cases rejected anyway. So you must understand as well your competitors' approval rate for this type of products, for this type of channels. And let's talk much more about it in a separate video. I think that's all about risk strategy. Okay, so I made this very simple table to show you how, again, important product and channel that you have, that not only risk guys impacting approval rate. So in case if you have good population and strong strategy, of course you can have high approval rate, very simple. But even in case if your population is good and your strategy is still simple, approval rate still can be high. As an example here is your repeated order clients, your loyal clients, which already with you very long time. You can make some very simple rooms, for example, no defaults, more than 30 days, more than 5 days to approve the customer, and your risk will be still under control. So that's an example of what can you have as a super simple strategy when your population is very good and pre-filtered. If your population is bad but your strategy is super strong, you still can achieve medium approval rate, though it will be closer to low approval rate, because these guys cannot make a miracle. If your population is extremely bad, if nobody have any intention to pay, doesn't matter how strong strategy you have. In the end, you will be not able to achieve high approval rate anyway. And of course, if your population is bad and your strategy is simple, like you are doomed, probably your approval rate will be very low or your risk will be super high. Because in the end, when we are talking about high, medium, low approval rate, it's all in assumption that you must achieve some level of risk, which we are talking about in your risk appetite. So that's comparison, how important is channel product, how important is risk strategy, what you can expect from approval rate in those cases. And just to summarize, what I want to summarize here, please, let's start from the bottom. Please look into channels and regions where you run the business, analyze your position there, analyze the differences, analyze your own data. It's always the best way to get some view on differences. About product, it's very important to explore your competitors, to explore the benchmark, how products and brands look like comparing to you, which we really discussed in the details on the previous slide, what are parameters you need to compare your competitors with you. And last point about strategy, about already risk, guys. Try to review and fine-tune your strategy regularly and try to achieve better balance of risk and approval rate. I hope it was useful. 2-3 points from this video I will be showing a more detailed video, so we'll be discussing you in details. And please let me know if something was unclear or you want to know something in more details. And thanks everyone for listening. Please expect new videos from me. It was Alex. Bye.